NVIDIA stock is down about 15% in the last 3 days, and this is because of a sales shortfall tied to their gaming revenue. So investors are wondering how much lower should they expect NVDA stock or NVIDIA stock to go in the future. And let's give a little context here. I mean, previously they were just shooting lights out. I mean, you had gaming revenue up 31%. This is the prior quarter. Data center up 83%. That's the bulk of their revenue. You can see 3.6 billion versus 3.8 billion, of their total 8.3 billion. So the business was up 46%. This is actually a really important data point for investors to see, which is this is the reason why a lot of professional investors look at price action just as a potential clue to say, hey, is the market starting to price in a scenario that hasn't yet happened with the numbers? And you saw that here with Nvidia, where you saw, hey, how come the stock is actually not doing that well? You saw the stock slowly selling off over the last few months, despite putting up, I'd argue, extremely strong prior quarter results. And it's because sometimes the markets anticipate things that have yet to happen. And in this case, arguably, the market started anticipating weaker results, which is really, from 46% growth to what now they're looking at, which is around 3% growth for their second quarter, where they're looking at the gaming segment down 33%. Data center, however, is still, a strong part of their business, up 61%. But those two, arguably the biggest drivers of this business, having one of their core engines down 30%, 33% is a big deal. And so is this game over? Well, let's actually hear what management had to say, where management was talking about how their sell-through projections declined significantly as the quarter progressed. So, i.e., things got worse throughout the quarter. Talking about macroeconomic conditions affecting sell-through to continue. So, hey, this is still a rough environment. And how they took actions with their gaming partners to adjust channel prices and inventory. What's that mean, like adjusting channel prices and inventory? That means markdowns. That means lower pricing in order to effectively move inventory. And so they were previously expecting around 8.1 billion in revenue. Now they're saying, yeah, it's going to be closer to 6.7 billion. That's a big haircut. Worse, that 6.7 billion has much lower margins. So that 6.7 billion that was sort of pushed out the door with lower pricing, where they previously were expecting with 8.1 billion in revenue, 65% gross margins, very rich gross margins, versus now they're saying closer to 44% gross margins. And so that makes you wonder, wow, that's a big cut to profitability. What are they doing about their operating expenses? And really, they're not doing much. You could see that they were previously penciling out 2.46 billion in operating expenses. Now it's around 2.42. So that's going to have a big impact on this business as you think about profit margins. And profit margins are what drives this business long term. And looking at previously around 35% operating profit margins, now dropping to 8%. So that swing from, let's say, 65% gross margin to 44% gross margin, just because you're not able to cut out your operating expenses. Your operating expenses aren't as variable. You got a lot of people, people aren't as variable as the operating expenses of, hey, we're going to lower, effectively the cost of these units, these GPUs. And so because of that, you should expect effectively operational deleveraging. So where usually you want operational leverage, where you're able to get higher margins over time, now you're getting operational deleveraging as you have the same fixed costs but lower margins, resulting in profits dropping significantly. And that's part of the reason why the stock's down about 15% over the last 3 days. But arguably, looking at this should, make your spidey sense tingle, because you're thinking, wait a second, that's a huge drop in profit margins. How likely is it going to stay? Because if it stays at this level of drop, this level of decline, wouldn't you expect a greater than 15% drop in the stock price? Now, arguably, Nvidia has gotten sort of an extra life, partly because management's like, whoa, hold on a second there with this sort of crazy, bearish thinking. Our long-term gross margin profile is intact. So they're trying to, address that concern upfront, talking about how, like, look, long-term, we still think we're going to be at that 65% margins. They're saying we have slowed operating expense growth. So they're operating their fixed costs that they're not going to be able to leverage as much. Yeah, they're slowing that down. They're not talking about layoffs. They're still thinking, yeah, long term we're growing. while managing near-term profitability. So i.e. it may not be as profitable as it was, but long-term we think we're going to get back to those really high margins. And they're also saying, look, the reason why we're going through this period is because of previous long-term purchase commitments we made during a time of severe component shortages. So you're going to get a lot of volatility. And here it is, they're not the only ones sort of talking about this. And this is another reason why you might argue Nvidia is getting sort of an extra life. The stock's not dropping as much as their profit margins are, partly because people are saying, well, wait a second, look at, GPUs, one of the core products that Nvidia sells. And, a lot of their pricing has dropped significantly tied to the crypto winter, where people don't need them anymore. You still need them for gaming, but it was unclear how much was driven by crypto. And so prices continue to drop, used GPUs, pricing dropping, but the rate of decrease has slowed down. And that might give some investors hope that maybe the worst is behind us. So hey, pricing won't keep dropping, margins won't keep going lower. So the question is, once again, looking at NVDA stock, Nvidia, how much lower does it potentially go from here? First, if you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. I talk more about unrivaledinvesting.com in the description of this video, including all the perks for Unrivaled Investing subscribers. And in full disclosure, this is not financial advice. And so looking at Nvidia, clearly they have a winning product, at least for the last few years. Historically, they've been taking market share. And that's what I like to see. When you see that their revenue is quickly outpacing their competitors, they're growing much faster, they're gobbling up the market, that means you're doing something right. That means you are adapting to the current realities better than your competitors are. You are offering a stronger value proposition. That is what I look for. That's why this channel is called Unrivaled Investing. I'm looking for those companies that are unrivaled, that are going to gobble that market share over time. And when you consistently gobble that share up, you are more likely to be a big winner. And that's what you've historically seen with Nvidia, NVDA stock, which has had a monster rally over several years. And you've seen it with their fundamentals. It's been driven by their fundamentals, whereas Intel is sort of languishing. You can see Nvidia has been a rock star. The question is, what's the right price for that? And this is honestly what scares me a little bit. Here's a price to sales multiple for it. And you can see that the price to sales multiple is effectively above where it's been for a long time, for the last 20 years. And the reason why this is a little alarming for me is the higher the valuation multiple, arguably the faster you're going to have to grow in the future. So it's effectively saying, yeah, the higher the valuation, you need to grow even faster than you did in the past. And by the way, your margins need to be even higher than in the past. So I look at this and this gets me concerned because I'm thinking to myself, wait a second, isn't the data points that we're seeing now suggesting that growth could be slower and that margins could be lower? And those data points suggest to me that you could have a much lower valuation in the future. And arguably, that's what you see in bear market bottoms. Bear market bottoms happen because expectations have just gotten completely gutted. They've gotten ripped apart. And people have low valuations because people say, hey, I don't expect strong growth in the future. I don't expect strong margins. That is the opposite of what you see with Nvidia's valuation, historic valuation chart on a price to sales multiple, where you're looking at this and it is still near record highs. Yes, it's down significantly from where it was, but relative to where it's been over the last 20 years, it is still quite high. And so that is something to be concerned about. Now, I did talk about this very dynamic before. I said, look, you could check out my prior video on Nvidia. I said, look, it's a great company, arguably. The question is, the valuation's probably just a bit too rich. And I'm still thinking arguably the same thing, looking at it now at $168. Previously, I was assuming even faster growth rates. And I was like, yeah, even assuming much faster growth rates, 30, 40% annual growth rates, I wasn't still penciling out crazy return. I was saying it's just too hard for me. Now looking at the stock price at 168, what's the growth rate this year? And this quarter, they're penciling out low single digits. I'm saying maybe for the year 5 to 15% growth. Maybe that's too aggressive. And keep in mind, this is a hypothetical valuation framework. Of course, stock price can go way higher, way lower. A lot depends on the execution. How do they actually perform? If their growth isn't, let's say as high as what I'm penciling out here and it's lower, their stock will get arguably absolutely hammered. But if it's much higher, then the stock should do much better. So I'm looking at this thinking, okay, let's have more reasonable conservative assumptions because arguably they're facing a tougher environment. That's what we've seen. So maybe 15 to 25% annual growth in the years ahead. Am I being too conservative here? If you have a strong opinion on it, I'd absolutely love to hear it in the comments below. I'm penciling out 15 to 25% annual growth in the years ahead. I'm assuming they are able to get back to their profit margin. So yes, saying, that 8% margin that you're potentially looking at this quarter, this profit margin that's way lower than they've historically been. Yeah, let's assume that that's a hiccup, that they get back to like 30, 35% profit margins. That's giving a lot of credit that we'll see. That's giving them a lot of value. Arguably that more conservative investors might say, oh, wait a second, why don't we discount that? Because arguably you're in a different environment now. And so looking at that 15 to 25% annualized growth, 30 to 35% optimized profit margins long-term, thinking about what's the right end multiple 5 years from now. Once again, this might be too high. This depends on their execution. I'm assuming 20 to 30 times. We'll see. But even in this scenario where I'm saying, hey, they're able to grow 15% on an annualized basis in the years ahead. They're able to get their margins back up to 30%, whereas they're not there. They're not going to be there this quarter, and they get to 20 times earnings 5 years from now. You're looking at 40% downside. That is quite a bit of downside. Now, if they're able to execute and you're able to get 25% annualized growth and back to the 35% profit margins, once again, they're not there, and a 30 times multiple, which I think honestly strikes me as pretty rich, then you're talking about 60% upside. So I'm still looking at the stock and thinking, unless I'm just way off with their growth rates, which is very possible. It's possible I'm really off with this growth rates. Then the stock just still doesn't strike me as highly compelling, in which case, arguably, you could still have a lot of downside. And this gets back to that valuation chart where I'm saying, wait a second, this valuation suggests that people are still expecting margins to go back to where they were and a resumption of hyper growth. And insofar that you still have that creates a lot of room for execution missteps, where if they don't deliver on that, the stock comes under pressure. So I personally would rather find situations where any sort of growth or the additional upside potential isn't being priced in. You're buying on a sale and you're like, hey, if they deliver just a little bit, then wow, you can have tremendous upside. That's how, for some of my investments that I want to look for with some more deep value. Yes, I definitely do appreciate growth at a reasonable price. But once again, looking at this, I'm saying to myself, is this a reasonable price? And that's tough for me to pencil out. I think you could see tremendous downside with NVIDIA stock. But if you have a different opinion, I'd love to hear it. If you think I'm missing something dramatically, I definitely want to hear your take. I appreciate you watching this video. Please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for watching Unrivaled Investing.